All right, let's get right into it. Today, we're tearing down an official brochure for a pretty popular financial product, LIC's Protection Plus. We're going to see exactly how it works, what it really costs you, and the big risks you need to have on your radar, all coming straight from the document itself. So where do we start? Well, right at the top. In all caps, the brochure gives you the single most important warning you need to hear. This one sentence sets the stage for everything else. It means the financial risk? It's on you. Not them, you. Let's keep that front and center as we go through this. So what in the world is this plan that starts with such a heavy disclaimer? The brochure calls it a plan that gives you life insurance cover cum savings. Now, that cum savings part tells you it's not just one thing. It's trying to be two things at once. And what this is something called a unit-linked insurance plan, or a ULIP for short. The easiest way to think about it is like a hybrid car. It's part insurance, part investment. A piece of your money goes to pay for life cover, and the rest gets invested in funds that are tied to the market's performance. So the brochure lays out a bunch of features that are all about flexibility. You've got the basic life insurance, sure, but you also get to pick where your money is invested. You can change your insurance amount. You can even pull some money out after 5 years. And one feature that really jumps out is this idea that they'll refund the cost of your insurance, the mortality charges, if you make it to the end of the policy. Interesting, right? Okay, now for the big question. Where does your money actually go when you pay a premium? Understanding this is so important because your whole premium almost never goes straight into the investment. There's a journey it takes first. And here's that journey, step by step. First, you pay your premium, but hold on, immediately a bunch of charges get sliced right off the top. Whatever is left over is then used to buy units in an investment fund, kind of like buying shares in a company. From that moment on, the value of your policy is all about how those units perform in the market. Now, this is where you get to be in the driver's seat, at least a little bit. You get to choose from 6 different funds, and they run the whole gamut, from a really low-risk bond fund to very high-risk funds that are chasing the big gains with India's top companies. Your choice here is basically you deciding how much risk you're willing to take on. All right, so we've covered how the money goes in and what happens to it. Now let's flip the coin. What's the potential payout? What are the benefits here? And what kind of wiggle room do you have with this policy over the long run? So there are really 2 main ways this policy pays out. First, there's the death benefit. That's the insurance part. If the policyholder passes away, their family gets a payout. They actually calculate 3 different numbers, and your nominee gets whichever one is the biggest. Then there's the maturity benefit. That's the investment part. If you outlive the policy, you get whatever your fund value is at that exact moment. The brochure also talks about these tools you have to manage the policy over time. After the first 5 years, you can take some money out. You can also move your investments between those different funds. You get 4 free switches a year. You can even add extra cash to your investment if you want. And there's the settlement option, which lets your family get the death benefit as a stream of income instead of one big check, which could actually be really helpful. Okay, let's pause. This next part is arguably the most important section of this whole breakdown: the charges. The fine print, because to know how much your money can grow, you first have to know how much is being taken away. These fees add up over time, and they can have a massive impact on your final returns. Let's dig in. The very first charge to hit you is the premium allocation charge. Think of it like an entry fee. Before your money even gets to the party, a piece of it is taken at the door. It's deducted from every single premium you pay, reducing the amount that actually gets invested. And this is a huge difference. Look at this. If you buy the policy through an agent, they take an 8% chunk out of your first year's premium. But if you buy it directly online, that charge drops to just 3%. That means way more of your own money gets to work for you right from day one if you buy online. That's a big deal. Next up, the mortality charge. Now, this is what you're actually paying for the insurance part of the plan. But it doesn't come out of your premium. No, it gets taken directly from your investment fund every single month. They do this by basically selling off a few of your units to cover the cost. And this charge goes up as you get older. And then, of course, you have the fund management charge. This is the fee you pay the folks who are managing your investments. It's a constant, slow drip, 1.35% a year, that's taken from your fund's value every single day, which gently pushes down the price of your units over time. Beyond those big 3, there are a few other little gotchas to be aware of. There's an admin charge that starts after 5 years. If you want to switch funds more than the 4 free times, it'll cost you. Same for taking money out. But the one to really watch is the discontinuance charge. That's a penalty if you stop paying your premiums too early. So let's tie all this together. We've seen the plan, the benefits, the costs. Now we have to come full circle, right back to that warning on the very first page, and talk about the risks. The brochure's pretty clear on these, so let's listen up. The number one rule you absolutely cannot forget is the 5-year lock-in period. The brochure puts it in all caps. You will not be able to get your money partially or fully for 5 years. For those first 5 years, that money is not yours to touch, period. And this is the whole game, right here. Your money isn't sitting in a safe, it's invested in the market. It can go up, which is great, but it can also go down. The brochure explicitly states that the value of your units may go up or down. There are absolutely no guarantees of a positive return. You know those sample illustrations they show you, with a nice 4% or maybe 8% return? Well, even the brochure itself tells you to take those with a huge grain of salt. It says right there that these projections are not guaranteed. They're just examples, not a promise. Your actual result is completely dependent on what the market does in the future. So after deconstructing this whole brochure, we're left with the big question, and this one's for you. This plan is a blend. It's protection mixed with risk. It's got potential, but it's also got a lot of charges and no guarantees. Is that specific mix the right move for your financial life? Well, that all depends on your goals and just how comfortable you are with the simple fact that the investment risk is borne by you.